right, thanks everyone. A reminder, the trolleys will be ready to ferry us away at 4:30. We'll keep things rolling here. This is the IPO Readiness Panel, the road to IPO. I'll ask my panelists to briefly introduce themselves.
Good afternoon, everyone. My name is Sherry Major. I'm a partner at KPMG and national leader of our capital markets readiness practice. So we help companies get ready for that journey of going public and being public with a focus around reporting, governance, and public company infrastructure.
Hi, good afternoon, everyone. Tara Jejic with the New York Stock Exchange. I head our U.S. listings, and the New York Stock Exchange is the world's largest stock exchange. We have a ringside seat as companies pivot from private to public, and have tremendous technology that is our platform and gateway, leading and deterministic, high resiliency, low latency, and an overlay of human accountability and oversight that improves the trading experience and market quality for our issuers.
Hi, Don Duffy. I co-run ICR. We are a communications and advisory firm. We're probably most known for working on about 25 to 30% of all the IPOs in any given year. We work across all sectors, and today we're about 400 people and work with about 700 public issuers.
I'm Ramy Lane. I'm a partner with Vincent & Elkins, focusing on capital markets transactions, including IPOs, follow-on offerings, public company reporting, and public M&A. And I've been practicing in this area for 21 years.
All right, great. Sherry, maybe we'll start with you, and this question is for all the panelists. Where are we at right now in the IPO window?
Every day is different. Well, certainly, I mean, we saw a little bit of a opening of the window here in Q3 that I think gave people some optimism, but we haven't seen sort of after IPO performance be where we'd like it to be, and so I think that has started to shut things down again. And now, you know, the companies that we're working with and talking to are really talking more about 2024. So I think we'll see the rest of Q4 here be relatively quiet, would be my expectation.
I concur. We have a robust pipeline of companies that are keeping their filings current with the SEC, so that when the window in the market does open up, they're ready to go. But as Sherry mentioned, the post-debut market performance has been a bit underwhelming, and geopolitical conflict and macroeconomic pressures, high interest rates are sort of tempering the water, so that not a lot of companies we see between now and the end of the year. Looks like 2024.
Yep, no, I would agree. I'd say the one thing, and really to contrast what was spoken about in some other panels, there's actually a lot of companies that have to go public because particularly in tech where you have a number of shareholders, it's not like a PE-backed company that has time, and healthcare the same thing. So I think to the comments earlier, there are a lot of companies that have been getting ready. They're in a lot of ways circling as waiting for the window to open. And we do think it's probably more likely 24. Certainly if we got some help from rates, it would be great. But I think every time it's felt like we're at the cusp, just like a month or so ago, things changed in the world or rate-wise, which held things up. But we're now in a 2-year lull, which is, I think, the worst IPO market in 50 years, something like that. So pretty tough.
People keep saying that, but I think this year was better than last.
Yeah.
It was just last was so bad. But, and then just to be clear, none of this for me is either investing or legal advice. I can give you legal advice if you're my client, but any investing advice I give you is horrible. So most of what I'm doing is just parroting things that I've heard smarter people tell my clients, which is the market's fragile right now. So yes, there have been some things going out, but most of them are not performing particularly well as compared to where they priced. So maybe there'll be a window.
Okay, last year the message was it's a great time to prepare. Is that still the case? Do you sense that optimism for 2024?
Yes, I do, actually. And I would agree. I mean, certainly this is the area where I spend the bulk of my time is helping companies prepare. So It probably does sound a little self-serving to say, yes, it is the time. But frankly, it is important, you know, if you're with an organization that's looking to go public, take advantage of this runway to get ready. Because if you wait till the market opens and then it's a rush, you're throwing bodies at it, it can be much more costly than if you've actually taken the time to do it more thoughtfully, leverage more internal resources. It just makes sense to not be doing this in a frantic state. And so the markets are slower, everyone's anticipating things opening up, so take the time now to get ready so that when things turn, you're good to go.
I absolutely agree. So we work with companies pretty early on. We are a resource for companies as they're going through the journey, and I completely agree with what Sherry said. So, you know, thinking about your financial statements, finding a reliable and reputable audit partner to work with, a law firm, an advisor on IR and PR strategies, the sooner the better. So making sure that you have these functions in place, you're working on financial and operational discipline, and getting really, you know, getting ready to go so that when you're at the right place in your corporate journey and the market's right, that you're ready.
Yeah, I would just add, I think what the last 2 years have told you is the windows can be a little quicker lately because things change fast. And I think if anything, if you look back to earlier this year, there actually were some good deals. Cava, Clavio, you know, ARM still is trading up. So a lot of people, if you go back and look as a whole, I think the group from 23 is flat, but there are some that have traded very well. But what I think it does tell you is the window opens, don't bet it will stay open for 2 or 3 years, so be prepared.
Yeah, I think that's important, and probably if you started preparing early next year, it would be too late, because I think at least consensus is late. The back half of next year is going to be ugly. So yes, if you're going to start preparing for 2024, it's the time is now.
Are there any sectors or industries that you feel will fare better than others?
Well, if you look at the class from 23, you know, consumer has done okay. You know, Cava did okay. There was a smaller restaurant IPO that did okay. I think a lot of people were focused on Instacart, which is actually reporting tonight. So hopefully they beat their numbers and it will trade a little bit better. But I think when you look at the deals, I think that are easier for consumers to digest or investors to digest, consumer seems to be performing fairly well. I think tech is difficult, and I'll mention Instacart again. Instacart went public. It was a down round to the last private round. That's pretty hard for venture investors to stomach, but I think it was a good sign for the market that they were willing to take a lower valuation to get liquidity. I think we heard a little bit of this on a prior panel about how people value some of their private holdings. I mean, you know, institutional money on an IPO wants value. So they want it priced at an appropriate discount. They want the company to perform well, beat and raise numbers, so that they can make money as well. And if an insider in those businesses is going to get liquidity, you want that company to perform similarly. So consumer backdrop is good, lends itself a little better, tech, and I think you've seen some decent healthcare deals as well, Jared.
Yeah, I'll add that Clavio is trading pretty well, and Fidelis Insurance Holdings is doing well as, you know, also. That was a June IPO. So we have seen consumer. Clavio was the first SaaS company that we'd seen go public since 2021. So that was a transaction a lot of people were watching, and it was hopeful with Instacart that it would open up the tech window, but not necessarily. We did have one MLP that just recently listed, Mach Energy, that traded well as well.
What are some of the keys to a successful IPO in this environment?
I'll start. I think first, you know, businesses need to, we talked about being prepared, but when you think about it from a market standpoint, you've got to be in a position to perform as a young public company. So you really want to be thinking about 1 to 2 years out. Is my model, my key KPIs, are they in shape? Do I feel like I have some tailwinds in the business? The worst thing that you can do is, as a young public company, underperform as you come out of the box. It's certainly a problem. And two, I think to some extent, you want to think about how investors are reacting to peers. We touched on this, what the right sectors are. But if peers are trading well, if there's tailwinds in a sector, it tends to bode well because institutional investors have made money. You're going to attract additional capital to the next interesting story.
Yeah, I think doing mock earnings calls, fine-tuning FP&A so it's accurate and predictable, and making sure that you're meeting investors early. If an investor is meeting you for the first time, when you're doing your roadshow, they may not be as likely to put in a buy order than if you picked selectively a few of the banking conferences or conferences in general and got in front of some investors to socialize who you are, what sets you apart, and why they should put your money in your business.
Yeah, and I would say, you often hear the 2 cardinal sins would be to miss your first filing deadline and to miss your earnings guidance. So a couple of the key areas to really focus on is practicing that rigor of public company reporting and public company timelines, and also really getting forecasting and budgeting, down so that from an FP&A perspective, you've got some track record of reliability into what you're going to be communicating to the street. And I think something that's probably more of a focus now than maybe a couple of years ago is not growth just for growth's sake, but profitable growth. So I'd say those are some of the key things we're seeing as being indicators of success of a public company.
Yeah, I think this goes more to success after the IPO than a successful IPO. I mean, a successful IPO is in large part luck. Just to be honest, but what really matters is you get public and then you perform well. And a whole lot of that is staffing and training and prep. And what happens is if people rush and aren't ready is when they stub their toe right out of the gate, to use a whole bunch of different sporting metaphors.
Also having a good governance structure. You want to have the oversight. You want to have the right board composition with the right voices in the room and the right committees established far enough in advance so that when you're hitting your first earnings call and you're going to overperform and not overperform and not overpromise, that those conversations and that the governance structure is set up.
We heard a lot earlier about that dirty word called SPAC. How do you see SPACs versus IPOs in today's environment?
Well, look, I think they're not appropriate for every company. I think you've heard some of the challenges and criticisms on the prior panel. There have been some highly successful ones like DraftKings and others that have worked out very well. I think in this environment, and again, this environment is certainly very different than 2 years ago, I think a company needs to think carefully about the amount of capital it actually needs to raise if it's contemplating a SPAC, who the SPAC partner is. They're not all created equal. You have seen private equity-backed sponsored SPACs that write their own check, InvestCorp, TPG, and others, so they put up 50 to sometimes over 100 million per deal. So those deals tend to have a smoother transition to the public markets, and they're getting access to the capital that they actually need. And so I'd say, just like anything, there were way too many SPACs for sure in 21 that ended up doing not high quality deals. They're throwing them all out. Certainly if you pick up the paper these days, there were some really high quality deals that worked well, but I think they're not suited for every company.
Yeah, I think from an origination standpoint, where the numbers of SPACs have normalized back to a pre-2019 era, few dozen versus a few hundred seems more in line with what can be accomplished on the business combination side.
I have a love-hate relationship with SPACs. I think, at the right time for the right company, they make sense. In 2020 and 2021, it was the right time for lots of them because you had sort of a natural investor appetite there. So it was easy way to go public and raise money for a lot of different companies. Now, it's really not. I mean, I watched the weekly results of votes and redemptions, and you now count as a success a de-SPAC where it's a double-digit non-redemption number, like 16% of the cash in trust staying in is now a good result. Most of them are sub 1%. So right now it's a way to go public. It's a horrible way to raise money for most companies.
Don, we talked a little bit about Instacart and Birkenstock. Firms are increasingly offering just 10% of shares in deals. Are investors paying the price?
Yeah, there's a lot being written now, and for those of you not familiar, but a lot of the bigger IPOs this year have used anchor investors. So a majority, in some cases, of the offering size was pre-sold or allocated to anchor investors. And so there's been some institutional grumbling about no float. It's a controversial subject because is it interest rates going higher after the deal price than a Middle East conflict that impacted the markets, or was it the deal allocation strategy? I think it was less the deal allocation strategy. I think, if anything, the markets got a little riskier. Investors weren't as interested in taking on a new position if they didn't get allocated shares in that IPO, and thus you didn't see some of the aftermarket performance. I think to some extent it goes back to how those companies perform now that they're public. Are they going to be good public companies, meet and beat earnings expectations? Let's see how they trade. I think in a volatile market, it's really hard to judge purely based on that strategy. I think for those size deals, I would say that was probably an appropriate strategy to get the deals done effectively.
Anyone else want to weigh in? Okay, how do you advise clients in a situation where we have an election year coming up, multiple geopolitical situations going on, high interest rates? How do you advise them?
Well, I think it's important for them to be, judicious around their capital today so that they have some flexibility. Right, so they're going to certainly only go to raise capital when they absolutely need it. And so really evaluating, is a private round the right way to go? Are the public markets going to be supportive of a transaction? So certainly evaluating their needs and the timing of, methodology of actually raising those funds. But to the extent they decide that IPO is the right avenue, keep in mind that we're going to have more volatility and turmoil in the last probably third of the year. So a lot of companies, I think, are going to be focusing on the first 8 months of 2024. And so you probably want to be at the front end of that to the extent that, you can be ready. And so really timing is key. And, as we mentioned earlier, being ready for when the markets open. And so there's some interesting dynamics that happen around, January timeframe for a calendar year company. So as you're thinking about, will the audit firm be comfortable signing off on financials in a registration statement that don't include audited year-end numbers, right? Which can happen in, say, the early January timeframe. There'll be requests for flash numbers, and what does that mean around what you're sharing with investors? And so it's just all these dynamics that will impact timing. So I think it's important to really surround yourself with, advisors and others that actually have done this many times before. It can help advise you around some of those unique traits and challenges, but those would be some of the things I think to think about around a 2024 IPO window.
Yeah, we all experienced a slowdown in early 2019 with a government shutdown too. So we're kind of hoping to avoid any disruption there, but we certainly saw, the deal flow slow down in early 2019, and it took a little while to pick back up after that.
I think I would just add the one other piece in a market where your window may be uncertain. We touched on this a little bit earlier, but investor education and some of the tactics around testing the waters that banks use. Institutions today don't want to meet you for the first time when you're about to sell them an IPO. So there's a great opportunity as the window isn't open to leverage an opportunity to meet key accounts. And to touch on this liquidity allocation thing Jarrett mentioned too, don't think about it as just the top 10. It's really the top 20 or 30. I know Tara mentioned conferences. You can kill a lot of birds with one stone at a conference, but spending face-to-face time, hitting Boston and New York and seeing top accounts, very important. We survey some of the largest buy-siders that participate in IPOs. They say they typically want to see a company 3 to 4 times before they go public. So in a time period where the window is not open, it's a great opportunity to invest in a future event by getting to know some potential top holders.
Yeah, I think, to maybe put it in a little bit of a pessimistic, tone, what we're all sort of saying is you kind of have to plan for your IPO not going well or not going at all in 2024. So you need to be judicious with your capital. You need to think about alternative capital raises. You can't plan on an IPO in 2024. You need to be ready if there is a brief window. So, it's sort of all hands on deck if you want that option, but you can't count on it. So you've got to think of something else.
How important is brand recognition? I'm thinking of like Slack, Spotify, ZipRecruiter. How do you think about that?
Yeah, we all discussed a few days ago just, there are many paths to public, and the SPAC business combination is one, and traditional IPO, a carve-out, a spin-off from an existing corporate issuer as a tax-free distribution to shareholders, reverse Morris trusts. But direct listing was a vehicle used by, Slack and Spotify and Roblox and Warby Parker because they do have, household brand recognition. They are known names with widely distributed shareholders who don't need the capital. So direct listing was a great option for those issuers. It's not perfect for everyone. We pioneered the process of direct listing in 2018, and last year got SEC blessing for direct listings with capital raise. We'll see when the market is warm enough to test that out, but I do think brand recognition like Kava was an example of one that folks know it. It's tangible. It's in your neighborhood. So I think there is a connection with those brands. Same with J&J, the Kenvue carve out. The brand, so you're curious about it.
I would agree. I would say, Jarrett, the one thing is if you're not geographically covered in, let's say, the Northeast, where you've got large accounts, you may want to think about it that way. Certainly healthcare or even at some tech names may not be necessarily top of mind to most investors. So I think as you think about investor education and awareness, it's important. I'd say the one other thing, pre-filing, I always tell companies is to also think about their digital footprint. I was on the buy side for 15 years. The first thing an analyst or a buy-sider is going to do is some simple online research. And if the last 2 articles written about your business weren't that great, well, that's the first thing people are going to read before they read the S1. So you do want to think about what people's perception is of your brand. We've come into that also with companies that are re-IPOing sometimes. It happened with Dave & Buster's years ago and a few others where investor perception of those businesses was not the greatest, but then you can take somebody like Panera, which is contemplating going public, and that was a very successful public company, has changed a bit since then. So I think brand matters, but if you're not a branded business or you're selling B2B software, so most institutional accounts may not know of you, you've got to think about that educational process, that awareness process, how you get them up the learning curve.
I think brand awareness is certainly helpful and can offset certain, sort of negatives the business has. But and it certainly helps if you're in a direct listing, if you're in a de-SPAC, if you're in something where you're not trying to allocate a big chunk to institutional investors. If you're trying to allocate to institutional investors, talking to them early through testing the waters or conferences or whatnot, and then also having analysts that really understand the business and can help explain it to institutions also is probably more important than brand recognition. So it kind of depends. I mean, it certainly doesn't help if people don't know your brand, but it doesn't necessarily carry the day on an IPO.
Yeah, and I think there's a thought that those companies that do have that brand recognition are the ones that are going to help the window open. So just create some momentum. So it needs to be a successful IPO, but I think having that brand recognition will certainly help the momentum as well.
All right, we'll leave it there on that note of optimism. My thanks to the panel here. And last panel of the day coming up. Thank you.